unless you've been living under a hole, you may have, or under a rock. I'm not sure how you can live under a hole.
I don't think you live under a hole.
You can't live under a
We're
hole.
off to a great start today.
You've been living in a cave under a rock. How's that? Then you've seen some market drops, and you've seen a lot of talk lately about interest rates rising, inflation, and all of that kind of stuff. And so what I thought would be really interesting today is to give a little bit of context on where we are, kind of how we got here, and hopefully a little perspective on what's going on. And so it's going to be slightly nerdy today, and I'm going to ask Mary for some major help in keeping us out of the what I'm calling the audible eye chart, because a lot of this is not visual, but keeping us focused on that side. But
so to that end, if you feel like, oh my gosh, are we headed for another 2008? What's happening? Should I be prepared for the next Great Depression? I think this conversation is going to be very insightful today.
Right. Well, and I think one of the articles that I've seen probably 3 or 4 of in the last 1 week is the 60-40 portfolio dead. And a lot of that is because we're in this weird environment where both stocks and bonds are down. And so where do you go to get money? Where do you go to get yield? And one of the big things that are causing the bond market especially to be down is the Fed is starting to raise interest rates. And the reason they're doing that is important because they're trying to soak up cash. They're trying to soak out some of the extra liquidity in the market that's causing that inflation.
So let's talk for a second about why that causes liquidity to shrink in the marketplace, because I think sometimes, we hear these things over and over again, and we're like, okay, but I don't really understand why. When you think about what happens as interest rates go up, people start trying to pay debt off faster. So that's money that instead of going to consumer goods goes or to growing a company starts going to paying back the bank, right? And so the bank starts to pull it in, but people also borrow less money when interest rates start rising as well, because the money has to work that much harder for them to create profit if they're investing it or using it to grow a business. And so what you see is less capital that is kind of flooding the marketplace. Whereas when interest rates go down and they get lower, people typically are more likely to take out loans. Like you might refinance a house and do a cash out because the money is cheap, or get a home equity line of credit. Whereas if interest rates start going up, your willingness to do that starts going down. And so there's less money coming out into the marketplace in that situation.
Yeah, and I want to pause for 2 seconds on something you said that was particularly brilliant, is that the hurdle rate for new projects becomes higher.
Right.
And I think when there's easy money, and you mentioned this in a client call yesterday, when the money is easy, you don't have to be really bright to make a profit. And what I mean by that is lots and lots of things become profitable, right? And so you may not work as hard or may not be as diligent in your discovery and your mapping out of the project, because you're like, well, interest rates are 2%, 3%, whatever it is. The hurdle rate for us to be profitable on this deal is not that much.
Yeah, efficiency doesn't matter quite as much, because if I'm borrowing money at 3%, as long as I can make, more than that, then I'm netting the spread between what I'm paying in interest and whatever it is I'm doing. And so I don't have to have a whole lot of return to make additional money. Whereas if I'm in a double-digit interest rate environment, that's a different story. If I'm borrowing money at 10%, I've got to make sure I really know what I'm doing. And I think that when you think about what that's really done over the past, in the last 13 years, because we've had that sort of easy money kind of feeling, it's created an environment that historically really hasn't existed.
Right. Yeah. And it's sort of distorting some of the decision making, I think, at an economic level, which is really interesting. So on the money supply piece of it, and where we get the money supply piece in the numbers, what we call M2 money supply, which is nerd talk for cash, deposits in the bank, and money that is pretty easy to turn into cash. That's fairly quick to get liquid. And so one of the things I thought might be helpful here is a little bit of context on where we've come from, and a little bit of understanding of why we're in this situation that we're in and why we're trying to, as Mary talked about, suck money out of the market, right? So if we go back in our nerdy time machine here to 1959, January 59 is kind of the earliest data that I've got on some of this. The number of dollars in the system was about $286 billion. So that was kind of the money supply. And over the next 50 years, so from 1959 to 2009, the money supply in the system grew, and it grew from about 286 billion to about 8.1 trillion. So 286 billion to 8,154 billion, if we're going to keep the units of measure. So that's a pretty big move. But it's a pretty big move over about 50 years.
A long period of time.
A really long period of time. So if you think about it, it's about $163 billion every year if we just annualized it out.
Mm-hmm.
Now, if we look at 2009, so think the Great Recession, 2008, 2009, the beginning of 2009, all the way through to yesterday or in March, then the number of dollars created in the system, or the amount that it's grown, grew by about 13.3 trillion, but it grew by 13.3 trillion in 13 years, which is ridiculous amounts of money, right? In that amount of money, which means instead of growing by about 163 billion a year, we grew by about a trillion or 1,000 billion every year for 13 years. And so over the course of the last 63 years, 60%, a little over 60% of the money that's in circulation got created in the last 13 years. And if you look at it even shorter, and this is the last nerd moment here, if you look at it from right before the pandemic, so February of 20 to last month, the number of dollars created in the last 2 years is about 6 trillion. So half of all the money that we've created in the last 13 years was created in the last 2.
And then you wonder why we have inflation. Because if there's more money and the same amount of goods, the goods are going to cost more. But I think it goes even beyond that, because not only do we have more money, we have less goods because we've had so much interruption in supply chain.
Right. Well, and I think it's the pen that broke the balloon, or whatever you want to call it, right? I think we've been building up to this over the last 13 years, but we've had just enough supply to kind of make it work.
Right.
And to kind of keep it at bay. And so when you had that one disruption for, 6, 12, 18 months in supply chain and all of those other things, then it's like it feels like the dam burst a little bit.
Right.
And so I think one of the other things, to your point earlier of, I think there may be a silver lining, is a little bit of context, and I'm going to nerd out 5.5 seconds, but I think this will help.
You've been nerding out the whole time. You need to stop with the caveats. Right. Just own it.
No doubt. So if you look at the 70s through, 1970 through probably about 80, 81, we've been in this situation before. Inflation was massive. The average inflation rate for that 13-year period was about 7.5, 7.6%. And the growth in the market, the average rate of return for that 13-year period was about 4.8%. So we've been in this sort of stagflation, high inflation, low productivity environment before. And what happened is, when he came into as the Fed chairman, right, Paul Volcker, probably 80, 81, started doing a big push to soak up a lot of liquidity in the market. Let's raise rates. Let's get some of that inflation under control and get that taken care of. And if you look at the results of some of his work in that next 13-year period, from basically 83 to 95, inflation went from 7.6 to about 3.5%. So it cut by more than a half. And the rate of return in the market for that 13-year period averaged about 12% a year, 12.7% a year for that period. And so I think the stuff that we're seeing right now, the home prices are going from 4% mortgages to 5.5 and maybe 6 here pretty soon, are not fun. They're not positive moves that we like to see when we're used to easy money, but I think it helps.
I actually think this is more of a return to normalcy.
Yeah.
I think that somebody was saying, oh man, interest rates they're so high right now. And if you look at them historically, they're still low. They're just higher than what we've seen over the past decade. And, I've said this before, but, this is the technical description of this. But I think what's happened is this sort of artificially low interest rate environment has created a bunch of like entrepreneurial weenies, right? Like it's easy to think, oh man, I got this. This is easy when there's this much money in the market space. And because money is so inexpensive to come by, even when you're selling your business, you can sell it for crazy multiples. Whereas when money is harder to come by, the multiples look different. If there's less money in the market space, it's harder to find investors or buyers for your company. And so it'll be interesting to see how even these small movements really begin to make a difference. But I do think there's some things happening that are kind of at odds where you're going to start to see some balance, because if you think about what happens with inflation, the price of goods goes up. So if you think about that in the housing market, if we have rampant inflation, you see housing prices go up. But if you think about the opposite side of that, as interest rates go up, what you typically see is house prices either stagnate or begin to go down. So you have some balancing pressures that are occurring here, and it'll be really interesting to see what happens. So yesterday when we were talking, you said something that I thought was really interesting when we were looking at some of the historics, and you gave kind of average market returns over a set period of time in different environments. Will you talk a little bit about that? Because I thought that was just fascinating.
Yeah. Well, and it comes to a quote that I heard a couple of days ago from Mark Twain, that history doesn't repeat itself, but it often rhymes. And
yeah,
so if
I
you
like
kind
that.
of look through those periods, right? So if we look through the last 13 years, 2009 to 21, the average rate of return in the market has actually been spectacular. Like,
sure.
Or
yeah,
out of
if you don't have to count 2008, it feels really nice.
It feels really nice, right? So 2009 to last year, the average rate of return in the market was about 14 and a quarter, 14.28, which is spectacular. Like that's not a normal environment. And if you look at the previous 13 years, that kind of 96 to 2008 kind of range, the average rate of return in the market was only about 5 and a quarter. And so,
and that's crazy because that also includes all of the tech run up, right? So those years where the market was returning, 33%.
Yeah. Oh yeah. I mean, you had 1996 at 20, 97 was 31, 98 was 26. We had some really big years. But
you have some big downs in that time period too. So if you think about that though, from a money supply perspective, it becomes really, really obvious how money supply affects the market. And really, if you go even a step behind that, it's how it's affecting business. And so as the money supply begins to normalize again, it'll be interesting to see what happens with business and business growth and how that impacts the market over time.
Yeah, well, and if we look through kind of the periods that we've been talking about so far, that kind of 1970 through last year, and I'm just going to do quick math because I've got a stupid computer in front of me. The average return for that period was about 9 and a quarter. So this idea that, and that doesn't include the 50s or the 60s or anything else. If you think about it, this period we've been in where we're getting average rates of return in the neighborhood of 14, that's way outsized, even if you look at just the past 30 or 40 years.
Right. Right.
And I think that's the recency bias of it is really a problem. Like 2008 is a historical
distant memory.
Yeah. Yeah. We remember,
especially for younger investors, I think. It's maybe they saw that it happened, or it happened to their parents, or it happened to them, but their balance in their 401k wasn't very big at that point. And so I definitely have noticed over, especially the past year or two, that clients are like, man, I just want to go all in. I want to go all in. And then right now we're starting to have that reality check where they're going, wait, what about defensive? What's happening there? And I think this speaks to a lot of the work that we're actually doing, which is how do you find return, right? You said earlier, you've read several articles that talk about, is the 60-40 portfolio dead? This is where I think there's an argument for responsive design, right? I mean, we have talked in previous podcasts about tactical versus strategic investing, buy and hold versus responsive. And, there are some people who are squarely in one camp or the other. And we're big believers that these are just tools that you can use, and having a balance between the two can be effective because they do different things in different markets. And having the ability to go inverse to whatever a particular market is doing can be incredibly valuable in a portfolio, especially if you don't have the kind of money that allows you access to a hedge fund or something of that nature. And so if you've got a portion of your portfolio that isn't just buying and doing whatever the market does, that allows you to go to the inverse in a market free fall, that can really help balance out return over time.
Yeah, well, and that third leg of the investment stool, what we would call the contractual,
Mhm.
insurance, the slow moving stuff that's not very sexy at the beginning, but 3, 4, 5, 6% without.
I'll tell you what, if everybody else is losing 55% in the market like 2008, and I'm clocking a 4% return, I am feeling really good about myself in some of those contractual investments. Right. So again, it's not either or, it should always be and. How are you looking at this so you can weather the volatile times or the times that have uncertainty? And this is where I think efficiency in the eventual income distribution is so important, because it relieves the pressure on your assets. Right? If I just have to go rate of return, and I'm constantly putting all of my money at risk, that can be very dangerous, especially in volatile markets. But if I have the ability to protect some of my capital and to create more efficient distribution, I don't have to take the same kind of risk. It becomes a choice. And when you have choices, it's not that you're in control, it's that you have a higher likelihood of good outcomes when you have the ability to make choices, as opposed to locking yourself into, I've got to do it this one way, and I hope to all get out that it works. Right? This is key, especially I think in this environment.
And then we'll wrap up here, but talk a little bit about the models that we use on the investment side. What are we shooting for year after year after year to make models work?
And this goes to, I think, just general expectation setting. And it's not to say that we don't want to do more than this, but I think in terms of what you should expect in general, regardless of who is managing your money, if you're looking at contractual type of returns, so we're talking life insurance, annuities, things that make sure you don't go backwards, you can probably expect over your lifetime anywhere from a 3 to a 6% return on something like that. If you're looking at money that's in the market, generally we're going to say, your expectation should be in that 6 to 10% range. I know when I'm doing my own projections, I'm hoping that we're going to do better than that, but I use 6% on all of it, because as I'm building a projection into the future, it's not, what does Biggie say? Mo money, mo problems. I have found that never to be true in our line of work. More money is never a problem. It's when you have less money that it's an issue. Right. So I think kind of setting that expectation of 6 to 10%, 10 being, in my opinion, really on the high side, is key. And then if you're doing real estate, private equity, something that's a bit more tangible that you can really dig into, I think then you can begin to expect the higher rates of return. But when you start looking across it, I think this idea that I'm going to get these giant rates of return in the market, unless you get lucky and you pick something that just happens to do really, really well, right, most of the time you might see higher rates of return doing things that are a little bit more tangible. Right. And that's why I tell people, like, if you're just set on, I got to get 15 to 20% a year, I'm not really sure that the market is where you're going to do that. So I think if you just kind of say contractual 3 to 6, investment 6 to 10, right, and then private equity, real estate, assets that are producing income, then you can start leaning into some of the potentially higher returns.
Right. Yeah. It's that core and explore. So.
Right. Perfect. Right. Exactly.
Thank you so much.
Thanks for joining us today. You can find me at The Wealth Woman. Eric, where can they find you?
Economics with Eric on Facebook.
You just need to change it to Ericonomics. I'm just going to tell you, you might as well just go there, because you do this almost every time. All right. Economics with Eric. You know where to find him. We'll see you next time.
Bye.